Jamie, top 5 real estate 411 key points when it comes to mortgage industry. You ready for these?
Yes.
I wrote these personally just for you and your visit here in the house.
I'm at the edge of my seat.
Awesome. Documents. Lenders will want extra diligent when it comes to underwriting home loans in 2014 as a new mortgage regulation is going to effect in January. Tell us why it is so critical that borrowers have the ability to prove that they can repay on their mortgage by keeping good records of bank statements, W-2s, tax returns. Why is all of that so critical in showing their credit worthiness to you?
Well, it goes back to a new law that came in with the qualified mortgage rule, and that's called the ability to repay rule.
The QM.
Yep, QM. The ability to repay rule says that a lender is required to verify that a mortgagee, someone who's going to take on a mortgage, has the ability to repay that loan. If we don't do those verifications and look at the documents and proof them up, well, then we can be liable as a lender for not verifying that. So having the documents in place, paycheck stubs, W-2s, make sure that you've filed your tax returns and have those. Can't do a mortgage without having your taxes done.
No, I've got 2 tax returns in process where people are going, can't you please hurry up? I got to refinance. I got to refi. So get the return done.
Bank statements, all of the above. And every single piece of those documents is important. So if you have deposits, large deposits on your bank statements, you have to document where that money came from. You cannot use mattress money.
So grandma gives you $500, you better have it documented.
Yep.
Good.
Gift letter, and if grandma gives you $500, well, grandma's got to be able to prove that she had the $500 to give to you, and then document that she gave it to you, and then you have to document that it's in your bank account as well.
So if grandma sells her Harley and gives you $500 out of it, she has to give a proof of selling that Harley?
Well, she has to have proof that she owned the Harley, first of all.
Wow.
Then she'll have to have proof, a bill of sale, that she sold it, and then show those funds going into her bank account, and then show the funds going out, and then going into the new bank account.
All right, that's just a cool grandma. Just a cool grandma.
If she's riding a Harley and giving away money.
Exactly.
Very cool grandma.
That's the perfect storm.
So we know that the scenario in the subprime mortgage lending craze back in the day was to not take documentation and just to go ahead and lend based on the credence of that human being having
It's
a
my
need.
word.
So
I'm telling you the
look what
truth.
happened to our economy based on just, hey, you need some help? Oh, I trust you. No problem. I mean, hey, we have to be accountable, so we have to be able to provide that documentation.
Number 2, lock in when you're comfortable with the rate, not trending what's going on. Don't get caught up in the actual interest rates, because interest rates are going to climb in 2014 because we know that the Federal Reserve is expected to reduce the pace of the economic stimulus program. But when is it a good time to lock in the rate?
Right away. If you're going to do a mortgage, you're going to buy a home, or you're going to refinance, and the market is in line and it's the right time for you to do so, then lock the rate. It's not good to gamble with something like that. In our case, if you apply with Somerset Lending and you lock in and all of a sudden the rates drop, well, then I can renegotiate and go to that lower rate.
That's exactly what I was going to ask you.
Right.
I mean, what's your time frame on that? Let's say Somerset doesn't process the documentation because they're waiting on documents from the potential mortgagee, and it's 30 or to 45 days and the rate changes, but they're locked in. You will allow them to make a change?
Yeah, I can do that renegotiation as long as it's within 15 days of the closing.
Okay.
So we have to be working with someone that's diligent about turning in their documentation and get everything turned in. Otherwise, there's a pretty significant cost associated with that renegotiation.
Ready?
I'm ready.
Refinancing. Many homeowners are thinking that refinancing is not an option any longer, but if their rate is above 5%, that does give enough spread for them to actually take a look at refinancing. Is this correct?
I like it. I like your answer. It depends.
I love it.
There really is no blanket answer when it comes to that. We really have to look at each client on an individual basis, case by case basis, to find out there's an actual benefit. So just because you may drop your interest rate 2% or 1% or whatever it is, it doesn't mean that it's going to necessarily make sense. It depends on what the individual's financial goals are.
I love that answer because Paul and I have been touting the whole aspect of not getting caught up in the interest rate, because depending on what you need to pay off on the mortgage will determine your savings based on the cost of refinancing. So it's very critical that you become completely educated on all the variables when refinancing. Don't get caught up into that interest rate. So that proves to our listeners that you and I have spoken in regards to making sure that our philosophies are met, are meeting, in regards to the education aspect of it. Number 4, do not overspend. Lenders don't want to give out loans to borrowers who have little money left each month after they pay their mortgages and other debt obligations, including credit cards and student loans. So tell us a little bit about the 43% of income ratio.
Yeah, 43% is the maximum total debt to income ratio. That would include your housing expense, to include taxes and insurance, property taxes and homeowners insurance, homeowners association fees. It includes revolving debt, credit cards, installment loans, child support. Any debts like that will go into that equation. So when you look at 43%, it would seem like that's a lot, but you're talking about 43% of your gross income. By the time you pay Uncle Sam and pay the state and your deductions all come out, you really don't have that much left over, depending on what your income base is. 43% is a pretty big number as it is. So, yeah.
When you brought up child support, does that also count towards income if they're receiving it?
Yes, if they can expect to receive it for 3 years.
So how is that proven in regards to it? Is it the payments that the person's been making towards the other parent, or how is that proven?
Well, there's a divorce decree and a separate court document that outlines child support and how much is paid, and the person receiving it has to prove that they actually receive it and it's been consistent. If it is inconsistent, then they won't allow it. The underwriters won't allow it.
That's what I was wondering. Yeah, because a lot of people have a divorce decree, but the payment doesn't always consistently come in every month. So I was wondering how all that works out.
That's always a very large caveat and factor in regards to the mortgage, is anybody having child support issues. It's just there. It's part of life. We understand these things, and we're here to educate you on your largest investment. This is Real Estate 411, and our website is realestate411now.com, and our toll-free line is 877-ANNETTE.